Yo, bulls and bears. What's up, stock market fiends? How's it going, friends? My name is Chase, but you can call me any 1 to 5 syllable word or word adjacent series of sounds that vaguely adhere to English phototonics and begin with the word ch. Alright. Gather round. It's time to listen to me talk about the markets. So before I make you a boatload of money, as we usually do on this channel, there's a couple of prerequisites that you need to fully comprehend the grandiosity of today's content. Firstly, open up your brokerage account and buy the dips on ticker NVDA, QQQ, CRM, SPY, PYPL, PAYC, AAPL, or any other ticker of your choice. Secondly, go tell your wife you love her. Thirdly, comment the word stocks in the comment section below and a randomly chosen winner will be gifted the first 24 hours of ad revenue from this video. And once you've completed all 3 prerequisites, it's time to go make some money. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell, and hit the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and quite a green day across the market. Broad-based gains, and in fact, we also saw some gains in some of the mega caps. Tesla, Amazon, Apple, Microsoft, they were all green and gained a healthy amount today on the back of stronger than expected economic data, initial jobless claims, GDP numbers, and that lent itself to the entire market really getting on a rally. Financials, Visa, MasterCard, PayPal up 4%. Industrials were really green, energy was the best performing sector, and even technology in the software space a very upbeat day. And the math is very simple. Strong growth heading into cutting cycles is really good for stocks, and that's why the market rallied today. But what really weighed on the market was semiconductors, specifically Nvidia, AVGO, AMD, as well as underperformance here from Google and Eli Lilly. Some of these stocks right here led technology to be the worst performing sector on the day, down 0.9%, and that is actually kind of crazy considering that Apple was up 1.5%, Microsoft was up 0.07%, so it just goes to show the weight of Nvidia and semiconductors in this sector right here. Consumer staples and real estate were the worst performing sectors, and that's simply because yields were up today on stronger than expected economic data, and they're gonna get hit hard, and they're gonna get hit hardest in the short term. The best performing sector was energy, financials, industrials, utilities, materials. Highly growth sensitive, GDP sensitive, and cyclical sectors performed the best. If we actually dive into a more expanded version of the sector analysis, look at the best performing stocks. XLE, IGV, KIE, that's insurance, XLF financials, FTN, the internet ETF, software essentially, XLI, XLB, XLU, IBB, regional banks, very cyclical, growth sensitive sectors perform the best today. And when you have stronger than expected economic data come through, especially on the growth side and the employment side, these stocks are going to rally, as well as small caps, up 0.6, 0.7, and 0.7% in value core and growth. Large cap growth and large cap core were the worst, but we did see quite an upbeat day here in value because financials and energy really held up this factor of the large cap spectrum. Mid caps actually performed really well today, but all eyes really were on the small cap space. But diving into the major indices more specifically, the IWM gained 0.72%, the Dow Jones 0.63%, the RSP 0.39%, and then you look at the Nasdaq 100 and the S&P 500. In a day where we had Apple gain, Microsoft gain, but Nvidia dumped on its earnings, great earnings by the way, the S&P 500 was actually flat. The Nasdaq 100 was down 0.15%. But this obviously doesn't tell the complete picture of the market. The S&P 500 was flat, but there were 342 gainers, 161 losers. And this is actually called a stealth bull market. It's where the major indices sort of just trade flat to down, but the average stock actually gains. We saw this in the year 2000. It happened when the Nasdaq came crashing down. The broader cyclical economy actually bottomed as the Nasdaq crashed. And had you been in the right stocks at the right times in that broadening, you did very well. And we're seeing a very similar scenario right here, although the dispersion and the beta is not quite as high. And the S&P 500 continues to trade sideways in a very tight range, near all-time highs in this very tight range, sort of just consolidating sideways, looking for the next big move. Will it be to the upside or downside? I favor more upside action, but not before volatility in September. We also saw some very interesting things in the S&P 500. The advanced decline line nearing all-time highs as the S&P 500 is not quite there, and the market on a technical basis still not quite overbought. We saw the 10-year yield did gain. The 30-year yield also gained as well, and we saw the dollar bid up. You'd think in that type of environment, smalls and large caps would come under pressure. That wasn't the case though, because the stronger yields and the stronger dollar were on the back of the better than expected economic data we got today, the stronger GDP print and the stronger initial jobless claims print. And that's why you have to provide context to the macro and how that impacts stocks. Yields going up aren't necessarily bad for stocks if it is supported by stronger growth. If it's not supported by stronger growth and higher inflation, that's really bad for stocks. That's what we saw in 2021. This is 2024. Stronger growth, yields can actually rise. That's a good thing. But part of the reason why we saw the dollar rise today was actually just a little bit of a rebound. The dollar has been a little bit of a dumpster fire. And so we're just seeing a rebound in the dollar, and then yields were on the back of the economic news. Gold and silver and Bitcoin all gained today. Bitcoin was up 0.88%, gold 0.7%, silver 1.15%, and crude up 2% here today. A great day for commodities. We already spoke about the major indices. Volatility was down 8%. Very interesting. It continues to be muted. Don't discount volatility, especially as we head into the month of September. And then the S&P 500. Guys, there's not much to talk about. Breadth looks good. We're not yet oversold. The only thing we're doing right now is just trading sideways as the average stock in the RSP goes ahead and actually rallies higher. We can see the S&P 500 not quite at all-time highs. The RSP actually made a wick all-time high, not a closing high. And on a year-to-date basis, up 11.15%. That's a very strong year considering we're going into September, which is about 75% the way through the year. Now, the S&P 500, nothing has really changed on the gamma chart. 5550 is still the gamma flip. 5450 is the put support. 5700 is the core resistance. We want to be buyers of dips here at the 5500 area, looking to find support right here and then make our next move higher. But if we do find price discovery below the 5550 area, that can spell trouble, and then we would look to the 5450 area. But we haven't seen much movement in the gamma tape, which means options traders are not really sure which way the market is going to go, at least in the S&P 500. They clearly know what's going to happen in the RSP. I think we're actually going to go higher. We then look at the IWM, very constructive. We saw 3 days of selling right here, and then we had a bounce back. Although that is a shooting star doji, that kind of looks really ugly in hindsight, but you have to provide context when it comes to these market moves. Also, we are seeing stuff like the Qs, the IWM, the S&P 500, and the RSP all year in the after hours gaining quite a lot. Qs would actually be positive on the day if you include post-market and real-time hours. And what a lot of people don't realize with the S&P 500 is that pretty much from late July up until now, the S&P 500 is pretty much flat. Earnings in that time period have actually grown 12%. Once this earnings season is over in a couple of weeks, the S&P 500 is actually going to be cheaper if we continue just to trade sideways. And this is just an opportunity to buy because the fundamental picture is still very sound. After today's data, we know the macro picture is very sound. It's just the technicals right now that are causing us a bit of issue. And we can see in the IWM and the RSP, that is simply not the case. But it's stuff like the Nasdaq 100 and the S&P 500 that is the case, because we have some of these larger semiconductor names and tech names not performing. And that's because they've just had blockbuster rallies for most of this year and for most of 2023. But the game plan for the S&P 500 heading into the rest of the week, we are going into a Labor Day weekend, and we could actually see some de-risking. But as long as we stay above the 5550, I think heading into the Labor Day weekend, I think this should be very constructive for us to make a move higher into next week and at least go touch back these highs and have some price discovery there next week. If we do close below the 5550 tomorrow, that can spell trouble, and we could maybe see lower levels, but it would have to depend on the structure of the market and what the other technicals are telling us. But we follow the trade plan, and above positive gamma, which is above the gamma flip, we buy dips, sell rips, and lean long, looking to our upside target of 5700. We are in positive gamma, so buy dips, sell rips. And diving into sentiment, this is the AA II sentiment survey. something we look at every single week, and nothing really has changed. What we did see was a massive tick up in bearish sentiment. We all know why, because in the last week, price has been on a bit of a digestion spree. But the reason why we actually kept bullish sentiment votes here in the 50s had to do with some of the price action we saw at the end of last week. Remember, this sentiment is just votes accumulated over the last 7 days. As you can see right here, from this week into this week, we had quite a lot of bullish price action with Jackson Hole last week, coupled with some of the bearishness we saw with the mega cap names this week, the price digestion we saw in the market, as well as some of the tech names being a little bit of a dumpster fire. That's why we saw bullish sentiment votes stay as they are, bearish sentiment votes tick up, and those in the neutral camp sort of just picked sides, and that was going to the bearish side right here. Nonetheless, we are in a bull market. There is still tons of bulls in this bull market, and as long as bullish sentiment is elevated, markets will continue to churn higher. But that might not be the case for the next couple of weeks, because Nvidia's earnings has been a key driver of broad market performance. When Nvidia produced a massive earnings beat, so too the market rallied. But when earnings came in subpar, the market also had subpar returns in the 2 weeks following. And so this data set, while a very thin data set, does foresee overall market weakness in the next couple of weeks. And let's say this data set continues on trend and we do get this weakness in the market over the next couple of weeks. We're getting this weakness heading into seasonally what is the weakest month of the year, September, returning about -1% and also having one of the worst hit rates, 45% up years compared to every other month, especially the negative months, May and February. However, diving into the details, not all of September is negative. If you look at median 2-week S&P 500 returns, you can see that the first half of September is actually slightly positive. It's just that the second half of September right here, which is the worst 2-week period in the entire year, is a huge dumpster fire, and you can see returns of -0.5% in the second half of September. And even still, when you look at the first half of September right here, this is actually the 5th worst 2-week period since 1950 in the S&P 500. But when you bring it back to the fundamentals, and this is really what matters in the long term, earnings are looking really good. The Mag 7 is growing earnings, and we are set to see a broadening out ex-Mag 7, ex-Mag 7, especially from the third quarter, fourth quarter onwards. You see a huge earnings broadening here with 17% predicted growth for the fourth quarter 2024, and margins are also looking really good. Current margins sitting at about 12.2%. And next 12 months forward margins looking at 13.3%. That's a 110 basis point margin improvement from now up until next year. Yes, I do think those figures are a little frothy, but I do think we see margins improve compared to the comparable quarter next year. And hyperscalers still have a long runway of spend. In fact, this quarter right here was the first quarter of a multi-year AI investment cycle that's going to benefit the market, the economy, Nvidia, semiconductors, and everything related to AI. This is something like 8% growth from here all the way until the fourth quarter of 2026. And this type of spend will be very accretive to earnings, especially in the technology space. It's essentially companies with big cash balances and huge R&D and CapEx budgets putting it into other tech companies like Nvidia, like semiconductors, like other software companies, hardware companies, and data center companies. And not to mention, we are going into a cutting cycle, and these estimates right here may even be baseline conservative, because during a cutting cycle, cash is simply cheaper, and these companies may even take on more debt to service their CapEx needs. And at the same time, this is some very interesting data here from the compound. S&P 500 12-month forward returns and drawdowns after Fed cutting cycles. The average positive return when we don't get a recession in the S&P 500 is 11%. When we get a recession, it's 8%, and then peak drawdowns respectively is 4% without a recession, 16% with a recession. That just means assuming we get a recession, we are going to have a violent drawdown. Normally we par that drawdown very quickly and have positive returns in the coming year into a cutting cycle. I don't think we're going to get a recession. The drawdown should be very minimal, but the upside should be exceptional, relatively speaking. And diving into some macro, we got the second quarter GDP advanced revisions. This is very interesting. Now, second quarter GDP is expected to come in at 2.8%, but we pretty much get revisions into the next year based on the data that we get, because this 2.8% we got last week was actually the advanced tracking estimate. But this right here is on a more complete data set. It got revised up to 3% from 2.8%. This was the expectation right here. And the BEA had this note. They said the GDP estimate released today is based on a more complete data set than was available for the advanced estimate issued last month. Compared to the first quarter, the acceleration in real GDP in the second quarter primarily reflected an upward revision in private inventory investment and an acceleration in consumer spending. At the same time as that, we also got better than expected initial jobless claims. The expectation there was 232,000. We got 231, so a slight beat, and a slight beat as well for continuing claims. And we spoke about this in yesterday's video. Based on war notices and jobless claim seasonality, we should actually see both continuing claims and jobless claims move lower into the end of the year. That's good for the economy, the consumer, and stocks. And all of this data here today points to stronger than expected growth, lower layoffs, stronger labor market, which is very important because we want to go into a cutting cycle with robust growth, not because of a recession, because equities do really well in that type of environment. And this data doesn't scream recession to me. And this is the data point I've seen floating around: US credit card debt balances delinquent more than 90 days, having a sharp rise, which is often not a good sign. And often we see similar surges in US credit card delinquencies during years of recession, like you can see here in the year 2000, 2008, as well as 2020 during the COVID situation. And there's no excuse that we could really make for this other than the fact that 90-day delinquencies are simply rising. At the same time, we are seeing US bankruptcies tick up in a very violent way. Unlike delinquencies, bankruptcies haven't touched their pre-COVID peaks or their pre-COVID average, which is around this area right here. And this is very fascinating. So we are having a tick up in delinquencies. Bankruptcies still remain historically low. And that's simply because of how Americans are actually tackling this situation. But the devil is always in the details. And when you actually dive into the bankruptcies by file type, even though we have seen a surge, it is still below the 2019 pre-COVID peak, and you can see that the majority of bankruptcies are reorganizations versus liquidations. This is why the bankruptcy system is set up like this. For those that did get caught holding the long straw with higher rates, they can now go ahead, reorganize themselves, restructure their assets, repurpose their debt, and the individual or the company can actually come out stronger through a reorganization. So until we actually see liquidations tick up to this level right here, that's when I would start getting really worried. Other than that, bankruptcies are not a concern unless they actually get back to their pre-COVID averages and we see liquidations tick up. Until then, this data is largely agnostic going into a cutting cycle. And then data in the week, it sort of seems like everyone has forgotten that we actually have inflation prints this week. Tomorrow we have personal income and personal spending income outlays. The forecast is 0.2 for personal income, personal spending to come in at 0.5. We also have PCE, headline, and core. The expectation, the month-over-month figures is 0.2. The year-over-year figures for the headline is 2.5%, 2.7% for core, and then we also get consumer sentiment. The median forecast there is 68%.